Richard, how you doing?
Hi, Richard.
Morning.
So you can see me screen. Just a couple of things. So I'm going to focus on SPY first of all, right? And obviously the Fed announcement yesterday. So let's talk about that. And if you can see the reaction in actually the market was down at 1.1%. And then it kind of came back a bit towards the end and just finished pretty much neutral. And today you can see in pre-market it's up about 0.7%. Now, what I'd say to you is that could change by the end of the day. We're just going to have to wait and see what way it all pans out. But just in summary, the Fed cut interest rates. You're well aware of that, and also indicated that it's possible they'll cut twice again. But Powell went and said it's data dependent. We'll see what happens, And then next year kind of was what really disappointed the market. And if I show you bond yields now just for a second, you can see bond yields actually went up after the announcement. And that's because there was no rate cuts actually factored in for next year. So remember the trade that we had put on, the options trade, I was saying that this might become a sell the news event. Well, it happened actually in the currency markets and in the bond markets. Started to happen in the stock market. But then it's kind of regained a bit of ground there. Powell pretty much delivered what was expected, but actually the market kind of took it that, they're not that dovish, as dovish as we thought. So dovish is where they think they're actually going to cut more rates more aggressively. So that's kind of the analysis of yesterday. So the market kind of did a head fake or a bottom fake and kind of just stabilized, and today it's up 0.75%. We'll see what's happening. I think the news with Nvidia and Intel's having a lot to do with that as well, by the way. So we'll jump onto that very quickly. So bottom line is Nvidia have just announced it's going to take a $5 billion stake in Intel, and both companies are up on the news, which is kind of unusual, really. But anyway, you can see Intel's up 30% in the pre-market and Nvidia's up 3%. Is there a trade in any of them now? I don't think so. It would be very speculative, and you can think about the option premiums. Even if you try to do an option trade later on, they'll have massive bid-ask spreads on them, and the VIX in those options, or not the VIX, the volatility in those options will be quite big. So it'll be very difficult to get an option trade on that will make any sense, at least in the first bit. Now, if Intel, for example, finished today up 30%, and tomorrow, maybe next week, I might look at a bearish trade on Intel because it's likely to give up some of those gains. So if you look at the chart here, Intel is going to open up here. Like, that's a big, big jump, even if it fills the gap back down to 28. So maybe next week we look at some sort of a bear put spread as a speculative trade, but doing it today ain't going to pay you. It's just that because the volatility will be so high because of the big jump, it won't be worth putting the trade on. So that's just Intel and Nvidia. So as expected with interest rates, bond yields kind of just went up initially. They're stabilized a bit. And if you looked at the dollar, actually, the dollar as well kind of was during the day at one stage was actually weakened quite a bit. It was over 119 and ended up strengthening on the day. So pretty much no movement in bonds or the currencies, which tells you the market expected what the Fed were going to say. Okay, so nothing of a major surprise came out there. Stock market foraging higher. Is it that Intel, Nvidia news? We'll have to wait and see. But again, don't be surprised if you see that reverse at some stage, okay? So trading into this market or buying into the S&P now, I don't think you can do. The trade we have on, I'm going to focus on just for the next 5 minutes. So we did the bear put spread that expires on October the 3rd, basically 660 to 650, and then we financed a bit of it with the October 17 short put down here. In terms of managing that trade, there's nothing to do today. So let's say SPY goes up today and everything like that, the trade will probably go into negative territory. Yesterday it closed up $22 per contract. It's probably going to be down today. It won't be down by too much, but it'll be down, I'd imagine. So what I'm looking at here with this trade and how to manage it is if, for example, we get to next week or even the week after, and there's absolutely no sign of the S&P pulling back, we might end up just selling the 660 put. So you can see yesterday that was worth $7.59. That's going to drop dramatically today, right? As the share price goes up. But let's say, remember, our entire trade only costs us $90. So when that 660 put gets to around the value of $1, for example, at that stage, I'm going to look at the risks to the trade and see if it's actually worth selling it to basically mean that we don't lose any money on the trade. Okay. So that's a potential management of this particular trade, but it's too early to do any of that now, right? Way too early. So we'll just keep an eye on the value of this 660 put. So we're going to assume now this trade isn't going for us, because to be honest with you, the catalyst for me was yesterday, you know, the Fed, and then how is the market going to react? And at one point I thought, you know what, we've got this trade bang on, and the market, it is a sell the news event. But now, as you can see today, market is up. We'll see how it plays out. So I'm trying to figure out what other news that's expected to come out in the next couple of weeks could actually cause the market to fall 2% or so. And right now, it's hard to see it because it's shrugging off everything, right? So for that reason, we're now going to focus our energy just for now on the 660 put. And when the value starts to drop to $1, then I'm going to evaluate, is it actually worth selling, just to close out this part of the trade, which will basically mean that we don't have any, or suppose we've claimed back the money we spent buying out the trade. It will leave two naked puts exposed here, so there will be a risk factor in it, but we'll see even that we close the entire bear put spread here at some stage. So for example, if we could close the entire bear put spread here today and probably generate $2 in premium here for ourselves, $3 in premium, and actually walk away with a net credit, and then we'll be left here with the 620 short put. But I'm not so convinced. I think it's too early to do that. So the risk management on this trade will be, we'll either sell the 660 put, or we'll actually sell the bear put spread side of it altogether and only leave the 620 short put outstanding. Okay, so I'll let you know if and when I decide to do that. So any questions on that, on how we'd manage it? Anything at all on SPY?
No.
All righty.
No, thanks. It's very clear. Thanks, Stephen.
Okay. So look, as regards TLT then, because it's directly impacted, you can see TLT kind of initially spiked, came down. And my view is you might see TLT start to trickle back down. I think bond yields might trickle back up to 4.2%. We'll see. If they do, TLT will come back down to around $88, $87. So to me, if you haven't sold TLT yet, I'd probably think about selling it. And that would be my gut feeling on the matter. But it's very hard to call. As regards currencies, I think now is a good time when if you're buying US assets, because I think the dollar is probably getting to a point where it's as weak as it's going to go. It probably 120. We're getting close to it. So, for example, when we talk about Workday, part of the issue of getting exposed to US assets was, of course, the currency risk. But I think the dollar at 120 is probably as weak as it's going to go. And that's going to bode well for you if you bought a company like Workday, for example. And I'll talk about that in a second. You know, because ultimately you're changing your money, if you are in the Eurozone, into US dollars. And then there's a cost to that, obviously, if the currency weakens against you. But if it strengthens, then actually you're benefiting from that, you know. So, you know, just in terms of where the US dollar is at. But in terms of trading both of them, I still think it's virtually impossible to trade them. And again, I think now, you know, between 118 and 120, I will be buying up US dollars with your euros. But let's see where this goes first. Give it a couple of days. Don't jump into anything. Natural gas, not tradable for me at this moment in time. It's gone up too much. So we need to wait and see what's happening there. Moving down, there's four stocks I wanted to talk about. SAP was one. So I went into the Share Navigator website and I did a screen, and SAP was one of these stocks that came up on my screen where the RSI, I was looking for RSIs below 30, and it was on this day the screen showed up, and stocks that had significant upside potential. So SAP, unfortunately, it's jumped quite a bit from here when it first came. It's gone up 10% in 2 days, which is a shame. But the reason I'm looking at that is this is a direct competitor to Oracle. And we all know what's happened to Oracle share price. I'll just bring it up here for you very quickly. And I was thinking there, like, obviously, what's so negative about SAP? You know, their earnings have been quite good. There's not been a problem. You can see Oracle's going a different direction altogether. And half the analysts are split on SAP. Half think that they don't have enough exposure to AI, and it's actually, you know, AI is going to replace a lot of the enterprise software. And half the other analysts don't totally disagree and say that'll never be the case, or at least in the short to medium term. And they're saying that this is an overreaction, this sell-off here in SAP. So again, it's what's the future direction of software with AI, and how far behind are SAP? And it's a big question to ask and answer. So I kind of dialed down the valuation multiples of SAP, and we were still getting kind of like a 260, 270 target price on the stock, which was substantial from where it was. So I was looking for some consolidation here. We're still in this downtrend, so I wouldn't jump on this now, but I just wanted to let you know it's in our watch list, and I wanted to explain the reasons why. Okay. The next two stocks that showed up in the screen are Gen Digital. So I have an alert on these and ICE, both for the same reason. So these are stocks that have some fundamental upside potential, but they're in an uptrend, right? They've made recent highs, all-time highs, and have just pulled back from those all-time highs to the moving average. So usually what happens in that situation, when the pullback is complete, it tends to go and have another attempt at the all-time high. If it doesn't get through it, it sells off. So these are what we would call potential short-term trading opportunities, is what I'm looking at between Intercontinental Exchange and Gen Digital. They're the same type of chart here. You can see previous all-time high with a pullback. And if we look at Gen Digital, all-time high up here with a pullback. Still in the downtrend. So I've set an alert here on my trading platform for if this downtrend gets broken and it starts trading outside this downtrend, I might look at a short-term stock trade on those two. So Gen Digital and ICE, let's call it just Gen and ICE here. I'm looking at a potential short-term stock trade on both of those. Now you could do that through options if you wanted as well when the time comes. It's up to you. At least with options, you know what you can lose, and if you're wrong, you're wrong. So you could do something like a bull call spread if you wanted. So just to give you an example, let's say today we've got that signal from ICE here, right? The stock is trading at 172. So let's say we did a 175, 180 bull call spread. So I'll go in here and have a quick look at that. The problem with doing it this way, by the way, before I continue, just to let you know, is that the challenge with doing these type of trades here with these companies is the time. Let's say you do an expiry for 2 or 3 weeks. Let's say the rebound happened today and tomorrow. If you do a bull call spread, you're only really benefiting at expiry at the full amount. So you're waiting around really for the move to happen. Even if the move has happened before your expiry, you're not going to get your full profit out of it. So it's important to understand that. So if you look at here, the 175, 180 bull call spread, that means you're risking here 180, okay, to make a potential 320. So you could risk $180 to make $320 per contract. That's roughly what that trade means there. So let me show you what I'm talking about in terms of the downside of this strategy. Okay, so we'd be buying the 175 call, we'd be selling the 180 call going out to October the 17th, right? So I'm going to go down to our what if scenarios. First of all, look at the profit probability. It's only 33%, right? Which isn't great. It hasn't done the scenario down here for whatever reason. But let's say in a week's time, the stock jumped to 180. You'd think you make your max return here of whatever, $273. You won't. And the reason is there's still time premium in the short put options, which are going to work against you. Okay. So that's the downside of doing something like a bull call spread. The reason I'm doing a bull call spread is because I want to offset some of the cost. You could look at just buying calls when you get your signal and taking your risk that way. So if you just bought the call, it's 285. That is a lot easier to work with because if the share price goes up, the value of those calls will go up too, and you will be able to sell out whenever you want. Whereas with the bull call spread, it's just while it's less risky in terms of what you're putting out there, you need it at that date to be above 180. Okay, so that's a certain way you could do it as well. Okay, if you wanted it, you could throw in there. If you wanted to add another leg here, you could throw in something like a short put at 160 to reduce the cost even further. You know, then you're on the hook. The risk of that one there is, potentially you might have to buy 100 shares of ICE. So there's a lot of different ways you could trade this. I think the simplest way is just buy the stock. To be honest with you, let it rally up and then get out of it and take your money as a short-term trade. That's the simplest way. Suppose using call options means you don't have as much money on the hook. So if you're wrong and this trend continues down, it's a false, and it can happen, you're not going to lose as much on that. I hope that makes sense. Any questions on any of that? No. Okay.
That makes sense.
Okay. So Workday, guys. Workday is a company that had news yesterday as well. So Elliott Investment Management, they're what they call an activist investor. So activist investors are investors that aren't going passively into a company to invest. They want seats on the board and they basically push hard for shareholder value. So they took a 2 billion stake in Workday. And Workday also on the same day announced that they're increasing their share repurchase program by 4 billion. So both of those pieces of news were very good. You can see how much it did rally at one point and it gave away some of those gains. So it ended up yesterday up 7%. Pre-market it's up another 1% today. So if we go to equity scan here and we look at Workday, it still has, we see a target price about 280 on it, which is actually nearly bang on with the analyst there. So that's quite a kind of a gain from here. And I think that might get upgraded too. So if you look from where we are now to where that could potentially go, that's a potential 19% gain. And it's only back in kind of May of this year was actually up there. So for me, that's positive. It's a break of this downtrend here. All I'm waiting for here really, folks, is will this actually pull back a bit? In the meantime, will we give away some of those gains after the jump and maybe with a view to buying in there? So again, you could buy the stock there. If we look at here, what's the dividend yield on it? Is 0. So if you went to the options market and you said, right, I'd prefer to do options because I'm not getting paid a dividend. You could do it a number of ways. Again, so it depends on your time frame again, and this is the challenge. You could go and buy, let's say, a call out to December, right? And this is the problem with buying call options. Wait and you see the time premium. So it's $15 for the 240 call. So that would need to get to 255 for you to break even. And it's at 237 now. So that's quite an increase. And then if it did reach our target price of 280 by Christmas, you'd be making a profit there of $25. So you'd be risking 15 to make 25. You could do it as a bull call spread. So that would be buying the 240 call, selling the 280 call. That would reduce your cost by $4. So you'd be risking 11 there to make
25.
29. Yeah. So
29.
So for me, guys, again, probably the simplest route is owning the stock. You're not under a clock, you see. This is the point. When you're buying call options, it's great. When you call it right, it's brilliant. Don't get me wrong. But I've done it enough times to know, by Jesus, if you're wrong, it's your investment down this money. Now, you're not losing as much money, but it's the time premium you're paying which bugs me. You know, you're paying $15 of time premium here. It's a lot. You know, it's not insignificant. It's 5, 6, 7% or whatever the value of it is. So I'm not a huge fan of it. If I was doing it there, I'd probably, if it a big enough account, I'd just sell a put option there as well to finance even more of it. But that's kind of and you got to give yourself some time for this to work out. To ask it to move from 240 to 280 is quite an ask in a short period of time, even 90 days. And the only reason I chose December, it's really because, you know, that Santa Claus rally, maybe it'll work its way up throughout that Santa Claus rally. So personally, myself, with these, I'd prefer to just own the stock on it. You know, rather than, you know, because timing, you know, when this is actually going to go up is quite difficult. Okay. So that's workday. Just all I'm doing is waiting here in a pullback or for it to stabilize here, see where it goes from here. I'm not seeing a huge follow through at the moment today, which is positive for us. It means that we might get it back down here at the low 220s, or maybe the low 230s, and look to buy in then. Okay. I know some of you are invested into gold and silver. So just looking at gold, there's another interesting reaction to yesterday. Gold prices came back quite substantially at one stage, actually yesterday, when they realized that the Feds mightn't cut rates as much. So that was interesting reaction in gold, and silver was the same, you know. So just again, this is all related to the value of the dollar and to inflationary prospects, etc., like that. So just overall, my overall opinion is, you know, the Fed cutting rates now, you know, they're more or less saying that it was the jobs data that has caused them to cut to try and get ahead of that. They see a slowdown in jobs. And now they're kind of saying that they think the inflation will be transitory. They're already seeing inflation from the tariffs, and they think it's going to last right through the early next year, but that they think it's going to be transitory. In other words, it's like a once-off impact, and that there's no need to keep rates high just for that reason alone. Now, I've been listening to a lot of analysts today, and I have to say, the divergence in views is unreal. Some think this is crazy and that it's actually going to cause major issues. And others think it's right. And what camp you're in, you know. So the short-term impact, rate cuts are good for stocks, guys. There's no way of getting around it. So I'm not seeing a huge sell-off anytime soon in the S&P 500. I think it's going to take something out of the left field. Something that nobody's expecting right now. Maybe a really, really bad jobs data report or GDP report or something like that. Something that nobody expects. And given the fact that, in my opinion, Donald Trump is now controlling economic data coming out of the US, what is that catalyst going to be? You know? Sorry, Richard, did you have a question there?
Oh, it was sort of a bit of a comment on the question. You know, just we haven't really. Sorry, you talked about potential events, and I wonder if that could be something related to the tariffs, like in particular with pharma and what Trump is planning to do. You know, I just wondered if you had any commentary on that, because we're still holding the likes of Novo Nordisk and Pfizer and so on. And I know that's a particular sector, it's not necessarily the broader economy, but I just wonder if tariffs could be that catalyst or not, in your view.
See, the tariffs are already there, priced in. I would have expected this market to be lower, to be quite honest with you, with tariffs already, and the market has shrugged it off. Now, I suppose the question should be, will the impact of tariffs cause the market to come down? And so far, the impact is there's certainly a weakening in jobs data right now. I know that from speaking to a lot of colleagues in different. It's quietly happening in Ireland as well, by the way, at the moment. There's headcounts getting cut quietly at the moment without any major announcements. So it is happening. And the question is, will it cause that inflation spike, which will cause the Fed to reverse pivot? Now, I think that will be an event that will cause the market to sell off. So let's say we get to the next Fed meeting and Jerome Powell says, oh, like this inflation data is terrible. The problem I have and why I don't think that's likely is because I actually think Trump is now turned the news flow, is controlling the news flow, the economic news flow out of the US, or at least he's trying to. So,
yeah.
So
even by firing the people that don't give him the numbers he wants.
Correct. So how do you get that? How do you get that piece of news that tells you, So I think all you will see it in the hiring. I think you will see it in the jobs data first. I think you'll see companies are a lot quicker to act than governments are, and I think the companies will be acting and all are doing it already. The question is, how deep does that get? And I think that might be a catalyst. So because the market couldn't care less about what's going on in the Middle East or the Ukraine. It doesn't care.
Yeah, for sure. Yeah. So anecdotally, just about job losses, I think there's a lot of companies, particularly in the tech space, who are letting go thousands of people, usually, entry and mid-level. And the company that I'm working with now, our founder and chairman is based in the US, and he's in that circle of tech CEOs and all that kind of stuff, and they're all telling him that every week they're issuing memos to their management team to say, listen, if you can't cut half your staff using AI, then you'll be cut, basically. So I think, and there's even, just reading the news yesterday, there's I think it was Anthropic were estimating that 50% of all new entry-level roles in the US alone will be cut, as in they just won't happen because they can be done with agents, or they can be done with AI as it's getting more powerful. And it's not, I've seen it myself, like a lot of my friends who are coders have all been let go. They're just not needed anymore. It's all product people who can tell the system what to be built. You don't need coders.
That ties in what I'm hearing as well. I've got friends who were in eBay, literally the couple of guys arrived over from the US, walked into the office and basically said, this division is now closed. You're going on garden leave, and you're going to be paid until this, and then we'll go through a period of consultation as to remuneration. That was it.
Yeah.
It was as cold and as quick as that. It was unbelievable. So
yeah, and it's all done by spreadsheets. Like in my last company, American company, the CFO contacted the HR guy in Dublin, and he literally sent him a spreadsheet, and he actually used the words, "I want you to delete those people." Sorry, what I mean is let them go. But because he had deleted them from his spreadsheet model, and it was profitable. So he said, I need you to delete those people.
Yeah.
The American companies.
Yeah, and like, so in one way you can see something like it. So let's think about as well, guys, what did the Fed actually say yesterday? He said he had a concern about the jobs market, and that's why the cut is happening. So let's say, take what he's saying at face value. If that situation worsens, then you're looking at a correction in the market, most certainly. So that narrative can change in a heartbeat. So just remember how the market is priced. It's priced on valuation multiples of expected earnings and sales going forward. Now, if all of a sudden people are losing their jobs, and that starts to become, or starts to amplify and multiply, the valuation multiples come down. Now, at this moment in time, the jobs data, whilst it has weakened, Edgard Denny, who's a guy I'd respect, he is a bull. He's always bullish, right? But he seems to think it's not a problem. It's actually, given the fact that they're at full employment, what do you expect? But he said we need to watch the space closely. Now, he totally disagrees with the Fed cutting rates. He thinks it's stupid, and it could lead to problems down the line. But his view is this is just going to pour fuel on the market, and the market's going to continue to melt up as a result. You know, so that's my point. The only thing I see now really impacting this is if we get jobs data that's really bad. The fact that Trump sacked the person that provides that data, and because he didn't say what they wanted, or she didn't say what he wanted, makes me think, are we actually even going to get that data? You know, so that's how difficult it is with this market at this moment in time. You know, it's quite difficult. So look, that trade we've got on, I'm less optimistic on it today than I was yesterday, simply because the market is doing this. Having said that, I'm not prepared to bail out of the trade yet. I'm going to give it a bit of time, and might start making some decisions next week. So if there's no sign of a correction, I might just take off the bear put spread side of it, and we'll end up actually having generated a credit by doing that. And then the only risk we have is the short 620 puts,
which can be managed.
Which can be easily managed. Exactly.
Yeah, you mean rolled out?
Yeah, absolutely. So like that trade, we actually might turn that into a winner by managing it. But I don't want to manage it just yet, because I'm still, as I said, it wouldn't surprise me if this market turned around and was down by the end of the day. You know, the pre-market, you take it with a pinch of salt. Let's see what happens throughout the day and tomorrow.
Yeah.
That was a very useful conversation there, Richard. Thanks for that.
Very good.
Yeah. So look, guys, that's kind of what I'm looking at. I'm looking at short-term trades on stocks, as opposed to, I'm really trying to find stuff that's in uptrends, and has just had a pullback recently, which is normal. I just want to satisfy myself that this pullback isn't the start of an even bigger pullback. So looking at short-term trades on this stuff, natural gas, not really interested for now. Not interested in trading currencies or TLT, and we have a trade on SPY, so we'll focus in on that trade for now. Any questions? Any stocks you want me to have a look at? No? Okay, guys.
No, thanks.
Have a great day, and we'll chat again soon. If you know where I am, if you need me, okay?